Thanks for joining us, and this is how to protect your portfolio. And a lot of people have a lot of allocation to bonds in their portfolio, and in a rising interest rate market, people don't really understand how devastating that can be to a portfolio. Now, sure, if and you hold it for 30 years, you're going to get par back for it, which is basically if you paid $1,000 for the bond, you're going to get that $1,000 back after 30 years. But the average person only holds their bonds for 7 years. And another thing is a lot of us have been getting ETFs, and if you have a portfolio manager, say for instance like a Vanguard or something like total return bond portfolios. Now those guys are going to be chasing yield, so I'm going to be talking about that a little bit more. But let me get a couple of things out of the way. One thing, this is being recorded, and I always say, if you're not familiar with options very well and you're starting to learn with this, please go back and watch it again because it really will make it sink in. My name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or the Wall Street Journal, where I've commented everything from economic to geopolitical and market analysis. I actually started trading in college. I started out with a psychology degree and started playing around with some money that I had earned throughout high school, started investing in some stocks, and started thinking, you know what, this is really what I want to do, and started switching it over from psychology to finance. And then decided after college I was going to move up to Chicago and start trading on the Board of Trade and start utilizing that finance degree. One thing I did realize though once I got there, that I probably had better education for this trading kind of thing with my psychology degree than I did even with my finance. So you know, there is a lot of psychology that goes into trading, and you know, keeping your powder dry, as we used to say on the floor. And a lot of that has to do with staying mechanical, because a lot of times we want to squeeze things a little bit further or don't want to take that loss. You know, you have to stay mechanical, know when to pull that ripcord, and that's really what the psychology comes in. Stick to the rules. Don't let yourself talk yourself out of anything. If you ever get that feeling where, you know what, I don't know if I like this anymore, should I cover it? As soon as you ask yourself, should I cover this trade, you know, that is likely the time that you really should cover that trade going forward. Always keep that in mind. You know, if you have that gut instinct, cover it. Just move on, and that goes even for a winner. If you start thinking, should I cover this? Yeah, that's probably the right time to cover it, and don't look back. All right, anyway, so in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. I've been down there when the craziest things have happened and gotten through it. So you guys will be able to get through it too. Stay mechanical. Anyway, I got to go over the disclaimer. It says any opinions, news, research, and analysis or other material provided by ProTrader Strategies and or associate companies, employees, is for general commentary and does not constitute investment advice or solicitation to buy or sell any of the securities or strategies. Basically what this is all saying is, without knowing your risk parameters, without knowing what's in your portfolio, it would not be right for me to tell you, hey, this is a trade recommendation. I can't do that because I don't know what your risk parameters is. It would not be fiscally responsible for me to do that. I mean, that's one thing that I just can't possibly do. It's up to you to kind of look at what I'm doing and implement it into your portfolios in your own way. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Also, hey, you guys, I'm on Twitter just about every day, and you can follow me on Twitter at Wolfman's blog, or you can follow ProTrader Strategies on Twitter at ProTrader Strat. So follow us. There's always good stuff coming out there, and ProTrader Strategies throws out some daily wisdoms and things like that. I usually throw out daily snark, so be prepared for that. And I also talk about different trades and what I see going on sometimes. Anyway, this is going to be how to use options to protect your bond portfolio. Now this, I'm going to be specifically looking at bonds today. And the reason why is because, you know, we just had this FOMC and they decided to keep interest rates unchanged. But in the future, it's going to, the rates have to go up at some point, right? They can't go much lower anyway. And you know, some people might be saying, you know what, the interest rates aren't going to rise, so maybe this isn't going to really affect me right now. Well, at the end of the day, we are going to try and get ahead of the curve, because once interest rates start rising, those bond prices go down, and it can be dramatic. One of the rules of thumb that we used to look at on the floor, and this is actually probably something I could add to the floor trader hacks for options, but we used to look at it like if the bonds, the 30-year bonds, went up by 1 percentage point. And so let's just look at it based on a 4% coupon. If interest rates go up by 1 percentage point, that bond price is going to go down by almost 15%. Now, why is that important? You know, I mean, because on $10,000 bonds, all right, it's going to go down by 15%. That means it's going to go down to $8,500. And if you get out of those and try and get into a bond that has that 5% coupon, so you get an extra $1,000 a year, it's going to take you quite a long time in order to recoup that loss. So it doesn't behoove you to just start rolling these out and chasing yield, which is what is going to happen with like bond fund managers and things of that nature. So this is basically a chart of bond prices, and as bond prices, or as, sorry, the interest rate increases, you can see how dramatic those bond prices are going to start to drop. So, you know, they increase by 5%, you're seeing a dramatic loss in your overall portfolio. And this is what I hinted along the lines. These are fund managers, Soros and the guy from, oh gosh, his name's, anyway, these guys are collecting all kinds of money off of these bond portfolios, ETFs, and things of that nature. But at the end of the day, if you think about it, these are yield chasing instruments. So if the interest rates go up to 5%, they're going to be rolling out of those bonds, and they're going to be buying high and selling low to chase that yield, which I just talked to you about it. There's no way that they can make up for those losses just on those bond prices, because they're not ever going to hold these bonds for 30 years and get par back out of them. They're going to be rolling out of them, meaning they're going to be buying a 4% coupon bond for $10,000, let's say. They're going to be rolling it out. Of course, it's a massive multiple of that. But they're going to be rolling out of those for $8,500 to get that extra 1% increase in the coupon payment. And it's just not going to work out very well in the long run. They're going to be continually chasing that yield. The only time that those guys will see a really big increase is when the interest rates go down. So, and in a interest rate environment where this interest rates are starting to go down, we wouldn't want to necessarily implement this type of strategy. This is in a rising interest rate market, or to get ahead of the curve on that rising interest rate market. So we're going to be looking at selling calls. And one thing to keep in mind, that when we're selling calls, and since a lot of people have these bonds in their IRAs, I'm going to show strategies how you can put this in your IRA also, so keep that in mind as well. But the higher risk trade is going to have higher reward. But keep in mind, higher risk means that you're risking more and you have more to lose. But at the end of the day, we have higher reward by doing that. Now, I go through this all the time. The keys to success on this is picking the right underlying. And with this being bonds, you're going to have to look at your portfolio and see how much you have in bonds, for one, to start. And for instance, if you have $100,000 worth of bonds, you'll probably be wanting to start looking at the CBOT's bonds, which is /ZB, because those are the big boys. That's basically one contract is going to be relatively equivalent to $100,000. So, and look at that as a multiple. If you have $500,000 in bonds, you're going to be wanting to look at hedging with 5 of those ZBs. But anything less than that, if you have $10,000 increments, let's say, then you'll be looking at TLT for the $10,000 increments also. And if you are really risk adverse, you wouldn't really want to do this, but TBT is another ETF, and it's triple leveraged to the negative side. So as it's a little bit different, where bonds, when interest rates go up, bonds go down, and when interest rates goes up, TLT goes down. The opposite happens 3 times with TBT, because it is a triple negative leveraged instrument. So it will go up 3 times as fast as the interest rates go up. So if you really hang around with some risk, or want to see it, or if you see an interest rate environment where it's really starting to rise, that could be the instrument to go into. But just keep in mind that TBT is directly correlated to increasing in interest rates, so, or decreasing in interest rates for that matter, whereas the other are opposite. You can think of the other as almost like a teeter-totter. As interest rates go up on the one side, the prices go down on the other side. Oh, I thought TBT was triple leverage. Maybe George is saying TMV is 3 times, TBT is only 2 times. We'll look at it when we pull it up. You might be right there. All right, so picking the right strikes. Now, like I mentioned earlier, you know, the higher risk, higher reward. With something like this, usually if you're doing negative, or if you're doing naked strategies, I like to try and look at like a half a standard deviation. That's for the higher risk profile person. So that would be around a 30, 31 delta. If you have a little bit less risk, or if you're a little bit more risk adverse, I should say, then you probably want to look at 1 standard deviation move, which is about a 16 delta. And here's the profile on figuring out standard deviation. And a lot of people will say, well, this isn't a perfect, or this is a perfect standard deviation curve. There's a lot of times there's going to be skew involved with the options and things of that nature, but you can rest assured that if you're looking at a 30 delta, it has that skew involved, and same with the 16 delta. There's skew embedded into those option prices. So that's usually where I start to look at it for these. So the 1 standard deviation is right around that 16 delta, and you can figure that out by adding 13.6 plus the 2.1 and the 1. You know, it's very close, rounded up. You're right there. All right, so, and then picking the right duration. With this, the brilliant thing with using TLT, TBT, the bonds, you can go into the options. So I like to set this up when there's just like less than, right around as close to 35 days as I can. The reason why is because we get this theta decay happening. That allows us to not be in this trade very long. I like to get out of these trades, especially when you're selling options, collecting a credit. You want to be out of these as quickly as you can and take your profits and run. I always say, don't ever, and I have a high risk parameter, don't ever go inside of like the 7-10 days. Yes, you are going to get a lot of theta decay happening there, but your risk is also going up. It's going to be a little bit more volatile. You have gamma risk that I'm not really going to go into now, but gamma changes the pricing relatively quickly the closer you get in here. So another thing that I talk about is taking a % of your max profit, which I'll go into here in a little bit. But another one is picking the right environment. Picking the right environment with this one, I usually talk about high volatility. We would much rather see high volatility. Right now, since we just had that FOMC, volatilities come out of a lot of these. But high volatility, when I'm doing, this is like a covered call in a sense, although it's not going to work the same because you can't really deliver the bonds that you have in your portfolio for the derivatives that we're going to be using. So you have to keep that in mind also. You have to be mindful that if it goes against you on those calls, it's not like it's going to get called away from you. You're actually going to have to deliver some bonds, and that could get messy. So we don't want to have that come about. We want to cover these before that, and we don't really want to get assigned on them. The other thing is picking the right environment. We definitely want to be looking at an environment where we have a rising interest rate. So that going forward, we want to be doing this right now because we can get ahead of the curve, and the probabilities of interest rates going up are better than the probabilities of interest rates going down. And know your exit strategy before entering the trade. Now, I always talk about this when collecting a credit for any option is our target is going to be taking 50% of that credit that we receive upon initiating the strategy. So if we collect $1, we're looking to exit around 50 cents. But we can even look at this, drill down on this a little bit better. This is a little cheat sheet thing that I use quite a bit just to keep me mechanical. The fact of the matter is if you can get 10% of your profit in one day, take it, because you've beaten the probabilities. This is beating the probabilities. If you can cover these trades within this, you get a 30% profit in 3 days or a 40% profit in 7 days, that's when you're going to look to take it. It's not always going to necessarily be shooting for 50% of your max profit. And usually I have found that to get 50% of your max profit, you're probably going to have to, it's probably going to take about 21 days on average, and 40% usually takes somewhere around 14%. So that's where I've come up with this, is noticing that the 10 and the 20 is a little off, but 30% usually takes about 7 days, being directionally right. 40% usually takes at least 14 days. 50% usually takes about 21 days. So if you can beat those averages, then you're ahead of the game, and you should really look at taking that. And won't this be day trading? Yes, but you can do it. It depends on how many occurrences you have. So if you're doing this a lot, then yes, you could fall into that day trading pattern rule. But if you're doing it like once, then you're really not going to fall into that day trading pattern rule. Trevor, you forgot to ask me the synthetic longs. When you said 10% pullback, do you mean a 10% pullback from the recent high, 52-week high? If I'm going to look at, yes, I would look at a pullback of 10% before I did those synthetic longs. Oh, John says, I don't think there's day trading rules for options. Not quite sure if that's true, though. I think you could, if you were in and out of options quite a bit, you could, it's only in equities, that very well may be true then, if you're pretty sure on it. I usually don't get in and out of options in a day either, but there have been occasions, and I haven't had anybody come at me, so you very well may be on to something there. All right, so our max profit, anytime we're doing anything for, yeah, so Farhead says day trading applies to options too. I rarely do in and out of options, but if that opportunity arises, I'm not afraid to pull the trigger on it. And like I said, I've traded a lot of options. I haven't really had anybody say. I've seen the notice come up before where it says, you know, I could be in jeopardy of, you know, compromising day trading rules, but I never had them come after me yet. So, but I'm not usually in and out in a day. So that's a rare. This is a very rare occurrence to get your 10% in a day or 20% in 2 days. 30% in 3 days is really hard to see, but once you start getting out to these 40, you could easily see 40% in 7 days and 50% in 14 days. And if you see that fast, take your money and run, because you have you are doing well over the probabilities of success there. And that's what this all comes down to, you guys, is your probabilities of success. Don't take undue risk. This is lowering your risk by doing this. And if you can continue to do it and keep beating those probabilities, you'll be well ahead of the game. All right, so keep in mind, like I said, max loss is unlimited. It's not going to stop because you have long bonds in your portfolio. Yeah, you are going to do better with your long bond portfolio, but this is only going to be talking about that short call, because that is what really is going to have unlimited risk. You can't deliver the bonds that you have in your portfolio unless, of course, you are long the futures. All right, your break even is going to be your short call plus that credit received. So you add your credit to whatever that short call is. That's where your break even starts to come into effect. All right, now if you were doing this in an IRA like we talked about, we are going to need to do this as a bear call spread. In a bear call spread, there's two ways to do this. One is to go and look at that 30 delta, 30-ish delta is what I like to say, because really to get a third the width of the price, which is what I'm usually looking at, you need to start with right around that 35 delta strike. And then the next strike up usually will give you a third the width of those strikes. So, on a bond, a /ZB, we're going to be looking at trying to collect $300 and risking the $700, $333 and risking the $666. And continually do that over time, because this is just inside of that one standard deviation move. The other thing is if you want to really not have that much risk on the table, you could move it out to the 16 delta 35 delta is right around the half standard deviation move. The 16 delta, which is the one standard deviation move, and then just buy the first strike that is basically for a nickel, and that usually correlates to around a 2 or a 3 delta. So if you're using bonds and you wanted to sell the 16 delta, look for that first strike that has a 2 or 3 delta, depending on your risk parameters. Now, if you're doing it that way, with the 16 delta and then buying the long 2 or 3 delta just to make it IRA appropriate, keep in mind you're not going to want to let that go all the way to that 2 or 3 delta. You're going to want to cover that well before you see that type of risk happening. So if you were risking, if you sold it at a 16 delta, let's say you collected 40 cents and you bought that 2 or 3 delta, that would probably be equal to around 45 cents. I would be covering this strategy if I was losing around $600 on it. So that would make it kind of equivalent to what that this strategy risk is. Does that make sense? And if you have a lower risk parameter, you could say if I collected $300, I'm not going to be willing to lose more than 600, or the 300 plus. Okay. Does this strategy assume that you have bonds in your portfolio? Not necessarily, but it is this. If you have bonds in your portfolio, this is the best way to protect that. If you don't have bonds in your portfolio, then I would wait to implement this strategy when implied volatility percent for, say, TLT is above 30. So I would go back to my major rules on that. If you have bonds in there, I'm not as concerned as having the high volatility for that underlying. We're looking at it as a covered call, and on a covered call you don't always have the opportunity to sell that covered call in high implied volatility. It's more of along the lines of the mentality with this. The reason why we're getting rid of that high implied volatility percent thinking is that we're really focused on lowering basis on the bonds that we have, or the ETFs that you might have in your 401k or anything else. So you can be looking at, if you have a 401k at work or something like that that you aren't allowed to trade, you can rest assured you have some type of bonds in that portfolio, and you can be thinking, I need to lower the basis there. Yeah, it's somewhere else in a different location, but you can still think that that's, you know, synthetically, I guess, if you will, you're lowering that cost basis on there, because you really are. At the end of the day, it's your money, right, and your risk. So just because it's in another location that you can't really touch, then you can still look at trying to lower that basis. Okay, I'm lost. Why would you want to hedge against interest rates if you don't have bonds in your portfolio? Well, for one, you could have the assumption, and it's all about trading and diversifying some of your risks. So if you're always trading stocks, then it is good to get into trading the bonds, for one, because you are diversifying your risk. The fact of the matter is, Farhad, if you have a 401k somewhere, there are bonds in there, because there's almost nobody that allocates a 401k strictly to stocks. There's going to be bonds in there, or some type of interest rate instrument in there, and usually it's going to be about 30 to 45% of it. So what I'm saying is, if you have a margin account or an IRA, maybe moved one of your 401ks over from an old job that you're trading, and you have a new job where you have a 401k, there's interest rate sensitive instruments in there. I mean, I can guarantee you, I can't imagine anybody ever setting up your 401k without even 10% allocated to bonds, and that would be like the highest risk parameter. So what I'm saying is, if you think about your entire wealth in these different portfolios, because you would have a 401k portfolio, maybe an IRA, and maybe a couple of different types of margin accounts, then think about all of it as being one, and even though you're selling options in your margin account, you're really trying to hedge that risk in the 401k that you can't touch. Okay? All right, so with that, with a short call spread, our maximum profit is, again, the net premium we received on that spread. Now, if we're starting out with like the 35 delta and picking the next strike out, collecting a third the width of the strike, our max profit is going to be targeted at $333, because I'm thinking about trying to at least collect that third the width of the strike. And then our max loss with the call spread is going to be that long call spread minus the short call spread. That's just to not make it negative. Long call spread minus the short call spread minus that net premium received. So basically, the width of the strikes minus that net premium received is what our max loss would be. So if we looked at the other scenario where we were looking at like the 16 delta and then picking that 3 delta for like a nickel, you know, our max loss is much greater than what this would be. So keep that also in mind. If you're risking that, if you collected $33, then think about, all right, I don't want to risk any more than that $600 on the other end. Does that make sense? All right, and then our break even is that short call plus the net premium received. So if you had a short call at LT at 131, let's say, and we collected 30 cents, our break even would be 131.33 on the upside. All right, so enough of the boring stuff, let's get into the platform here. Can everybody see that then? So I just have TLT up here, and just as a note, let's just go look back at TBT. See if that's, yeah, it's the ultra short. It doesn't say, so I'd probably have to look that up real quick. Anyway, so with TLT and TBT, as you can see, as TBT goes down, we can see that TLT would go up. So they're inversely correlated in a sense. Of course, the ultra short TBT is, as I think it was it John? It is 2 times leveraged. So it's negative 2 times leveraged rather than 3 times I was saying. So it's TBT is 2 times leveraged to the negative side. So that's why it's going down as TLT goes up. All right, but let's look at the bonds also. Bonds, one thing to note with bonds is they're a little bit funny in that it's a little bit harder to determine what the pricing is on these instruments because they're trading in fractions and things of that nature. One thing I don't know if I mentioned, the beauty in these is that you can go into the weeklies whenever it's the closest. But as you can see here, so bonds trade in 30 seconds, and each 30 second is, the reason why it's traded in 30 seconds is because 1 point is worth $1,000. 30 seconds of that, is going to be 31.25. So each one tick from 25 to 26 is $31.25. Well, these trade in 64ths, which makes it $15.62.5, which makes that a little weird. But just to keep in mind, that's if you're trading with a big portfolio of bonds, this is probably the one you're going to want to use for several different reasons. One being you're going to have to pay less in commissions by doing the ZB. The other is you're not going to have to do so many multiples of it. But you'll definitely save, and there's also tax benefits by using ZB also. But I'm not an accountant, so I can't give you guys any advice on that. But you can talk to your accountant about it. You should get breaks on it, but keep that in mind. These trade in 64ths rather than in the 30 seconds, which these trade in. But if you have a massive portfolio, start looking at these rather than doing 10 lots of TLT to 1 lot of these is kind of the idea there for the equivalency. All right, so let's look at TLT because I think that this will be something that most people would have in their account or be appropriate for most people's accounts. So here's what I was talking about. We're going to kind of start around this 35 delta. And like I said, the one standard deviation would probably be right around this 30 delta. But as you'll notice, if we go to sell this one, and buy the next one out. So let's go $1 wide is usually what I look at. You can see it's close to 30% or 33. It was actually so. That's the 38. So 35 is usually the wheelhouse to give you around a third the width of the strike. So if we look at this one, you can see. Oops, I'm going to skip a strike. So the 38.5s. Let's make 39s. So make it $1. You can see that the 39s are closer to that third the width of the strike. Now, if you're worried about it, or you look at the charts and say, 38s is easily attainable. I don't want to take that much risk right now because they could drift back up. Whatever your mentality is, that's usually where I start. But keep this in mind with your own risk parameters. So the other thing you could look at doing is going back out a little further, looking at like this 16-17 delta, which gives you the real 1 standard deviation. The 30 delta is the half standard deviation. Sorry if I said 1 standard. It's a half a standard deviation for the 30, 31s. The 16s are the 1 standard deviation move, which means that only 16% of the time will this strike be in the money at expiration. So that has a high probability of success. So like I said down here when we were trying to get a third the width of the strike, if you go out to the 16 delta, lo and behold, it's right there around the same price, but you're further away. So we could sell this for 35 cents, and then I usually go out with these and try and buy the first one that is a nickel to create that. Now again, you can see it's 7 ticks wide, which we really wouldn't want to have that much. We wouldn't want that to go to the point of taking a max loss on this. So you're gonna, this would be more appropriate for somebody who's looking at this on a daily basis and or is very involved in their portfolio. The other one where it's a little bit more defined, where you know what you're getting into, that could be more appropriate for you to let it go out and ride. If you're selling naked strategies, like selling this naked, I would not just never go back and look at it again because it really could start to hurt. So I would look at buying that first one for a nickel, and as you can see, your risk, your max profit would be that $36, but your max loss is $664. That's just ridiculous. The risk reward there just does not pay it, or does not pay off. Do I look at the probabilities of, are you just meaning OTM, out of the money, Peter? Okay. Do I look at the probabilities of out of the money? If you're meaning, do I go up here and then do the probabilities of out of the money? No, I don't. I just do the math in my head for those. It's really close. So if you look at the probabilities of being out of the money for the strikes that I was looking at, like the 16 strike, it's the 41. So you can see that the probability of being out of the money is basically the inverse of the probability of, or the inverse of the delta. So right here, yeah, so it's 17, so it's really close. You know, if we're talking percent or decimal points of it, you can see a 17 delta means I look at it like the probability of being in the money, which is the inverse of the probability of being out of the money, right? So the probability of being out of the money on these 17 deltas is 83%. The probability of being out of the money of these is about 85%. So I don't go back and forth. You know, if it's off by 1 or 2 percentage points, to me, that's not going to make or break anything. For one, it's all a guesstimation, if you will. It's better than a guesstimation, don't get me wrong, but you know, 1 percentage point on in the money or out of the money is really neither here nor there. So I just look at it for the delta. That's my probability of being in the money. Okay, so and I play the probabilities that way. So that's the way I look at it. If you're more comfortable looking over across at it, you know, you could look at it like you shave 1%, one delta, and that's your probability. The probability minus 100 is probability of being out of the money, but that's pretty confusing. So I just look at it for the delta and look at it as it's the probability of being out of the money. or yeah, in the money, out of the money, however. I look at it the probability being in the money. All right, so that's how I would play this, but again, you know, I wouldn't risk all the way to 48. I would be looking to get out, if I collected 36 cents, looking to get out at a $600 loser. And your break even on this would be when the underlying is trading at 141.36. And that puts you well above this, which is going to be a resistance area. So I don't know if you guys do a lot of technical analysis and stuff. This is we called it Stoudemire on the floor, and I always have trouble. It's the market or volume and market profile on this. So the blue is where the volume's traded, and the numbers are where the time is traded. And really what it does is it kind of gives you the psychology of the market. Psychology of the market over the last year believes that this is where price has been discovered. This is where the most time has been spent. This is where the most people have put their money where their mouth is. And you can see that it has two distinct nodes. So you know, it may want to go up to here as well, but you know, these guys up here are overhead supply is what we would call, and you know, the further away it gets from that, the more anxious they get because they know it's going to want to go down to here. So anyway, but this is acting as resistance, this is acting as support, and then if you like your Fibonacci levels, then you can throw those in there too. I do look at those on occasion as well, because a lot of times you will notice here that the Fibonacci levels line up pretty much with either the high volume node or the low volume node, and they have a tendency to really mimic each other. As a matter of fact, the 50% retracement is right there at the point of control. So you know, they all have a tendency to kind of work out. Did you use market profile a lot on the floor? Yes, it was. As a matter of fact, it was started by a floor trader, and his name was Stoudemire. His last name is Stoudemire. That's why I call it the Stoudemire. It's been so long, I can't remember what his first name is. I think it was Stan or something. But yeah, we used this a lot. But we didn't have the volume in it. It was more the time was the important factor there. And that's what they call monkey bars here, probably because I think he trademarked Stoudemire. So that's why they throw out monkey bars, and who knows where they came up with that name. So that's why I still use it, because it does tell you where this, it's monkey bars only on toss. Yeah, it's probably because everybody's, I mean, it's not hard to come up with where the volume increments land, so you can pretty much do it with anything you want. And we used to do it with the X's and O's too, with the point and figures. No other broker calls them monkey bars. Oh, okay. And Peter Stoudemire, you're right. Yeah, Peter Stoudemire, that's right. So yeah, and that's why I like to follow it, is because it really tells you the psychology of the market. The psychology of the market, when it gets real thin, it's telling me that, you know, there's not a lot of participation. People are starting to not believe anymore. When it gets down here, everybody's happy and cozy because the long and the shorts are right there at their happy medium in a sense. Does a credit spread really protect the portfolio from rising interest rates or just supplement income? It protects it in the sense, it doesn't really protect it, you're right. But what it does is it lowers your basis on those. So in that lowering of the basis, you are protecting yourself on the lower bond prices, because you're lowering your basis on it. So it's a little bit easier to think about it maybe on a stock, okay? If you bought a stock for $100 and sold a call for $1. Now you're lowered your basis on that stock to 99. So think of it that way. So every dollar you collect on this, you're lowering your basis on those interest rate derivative, or on those interest rate products. So if interest rates rise, you really have protected yourself on the downside. Chris is asking, does it signal supply and demand levels? If you're talking with the market profile, it's, in a sense, it does, only when you really start to see it thin out. I mean, you're not really seeing supply side necessarily, but you are seeing demand for it shrink up. If there's no trade there, there's no demand for it, right? There's still supply there, but there's just no real demand for it. And if there's no real demand for it, it has to go back to where there's demand. And the demand, you could look at it like right here at the point of control, there's demand there because the people that are short down here want to get out for a scratch. And if it comes back down here, people that are long here are going to be like, I'm going to try and take any chance I can get to get out for at least a little bit of a profit. So that's the idea, is that it's going to want to migrate back there. Okay, 36 cents does not sound like much on $100 plus investment. But I can understand that if you're looking at, but we're looking at trying to do multiple occurrences here. So if we're going to be looking at taking about 20 cents on a $36 thing, somewhere close to that, it'd be, you know, 17, 18 cents. So 20 cents, let's say. If you can continually do that on multiple occasions because your probabilities are in your favor, you're going to be able to exceed the probabilities because you're never allowing it to go to that point of expiration. You know, think about it when I showed that chart of covering it early and often. Covering it early and often, you're beating the probabilities. So in a sense, that one time that it happens is going to be even more rare of an occasion than what the probability suggests as a delta, or in the money, out of the money. And it's not a lot, but we're looking at doing this continuously and rolling that out, doing it over and over, and continuing to lower our basis. I mean, if I could give you $20 or $20 every month, Peter, would you take it? All right. So that's the idea: is don't allow it to work against. Don't allow the probabilities to work in their favor. Have the probabilities work in your favor, and that's why if you can take 50% of that, you're not taking that undue risk of. Especially those last 7 or 8 days, because you know some wacky things can happen. So look, keep that chart that I had up on your sticky notes or something like that next to your computer, and follow that. You know, if you get 10% in one day, take it, because you really beaten the probabilities, and that won't seem like a whole lot, but you know, over time, as you continually to keep, you know, giving those jabs, you're going to knock it out. Does anybody else have any other questions about this? All right, well, that's it for the, so keep in mind, follow us on Twitter, you guys. You know, I always talk about stuff on Twitter, and love to have the back and forth stuff on there. So follow us on Twitter at Wolfman's blog, or you can follow us at ProTraderStrat. One thing is, we got this ProTrader hacks thing. You know, I even talk about delta. There's so many different ways that you can think about delta. You know, like I talked about how I thought about delta as being probability of being in the money versus the probability of being out of the money with the chart. How you can quickly look back and forth on those. I also talk about probability of being tested, like if what the delta is, and tells you, the delta tells you what your probability of being tested on that strike that you have. So those are quick floor trader hacks that you can look at, just like that little hack that I showed you with the probability. The delta is the probability of being out of the money, and the inverse is the probability, or sorry, delta is the probability of being in the money, and if you flip it, then that's the probability of being out of the money. What percent return on risk do you strive for per month? Great question. I don't look at it as a percent of risk. I look at it as a probability of success. So I'm not trying to get a percent of risk that I've outlaid. I'm looking at the probability of success. Does that make sense? So that's the way I play it, as probabilities, not really as a percent of what I'm risking. Anyway, so these floor trader hacks, there's all kinds of different ones in there. I also show you how to look at that same options page I showed you, which can show you where volatility is expected to crush to. I talk about the probabilities of sorry, I'm getting blown up with some questions here. I'll answer the questions here in just a minute. But basically, all in all, if you guys want to trade like professional traders, these hacks are going to help save time and a lot of punching into the calculator. If you can just look at that same options screen, see what volatility is going to crush to, know what your probabilities of success are, know what your probabilities of being tested are, it's going to make you a more consistent trader and increase your probabilities of success in the long run. So I also teach the right things to look at before implementing any type of strategy. So you can go to that chat box. There should be a link in there that you can get connected to this. One other thing is you also get free access to me. So if there is a trade that's going against you guys, reach out to me, because I'm more than happy to talk to you about what my rules are around that. I also have a no inbox policy, so if you guys write to me, everybody's going to get answered. And don't feel like you have a silly question or something like that, or maybe you may have missed something or whatever. I'm more than happy to go over that with you. Also, with this, you get the daily market commentaries, where I talk about every single trade I put on, why I put it on, how I take it off, if it's going against me, how I'm managing that risk, how I'm defending a strategy, and you know, when and where I find trades appropriate. So you can check that out, and follow me on Twitter, because I tweet out some things, especially during earnings season, what I'm looking at. All right, so check that out in the chat box. You know, this is going to save you a lot of time and money in the long run if you take advantage of this special offer, for sure. And I'll start answering a couple questions. One thing is, keep in mind, reach out to us if you have an option strategy you want us to look at and do a webinar on. And other webinars, I'm going to be drilling down on different option components and when and where I find them appropriate. Here's also that options hack special offer, but again, it's easier just to click on it in that chat box. If you have any questions, reach out to us at 310-598-6677, or you can email us at trading@protraderstrategies.com. All right, so there's a couple questions that were coming up. I thought it looked like it was scrolling. Would you use the same method for protecting a stock portfolio only using SPX? Well, Stan, great question. Now, SPX, in a sense, would be for the bigger portfolio, and yes, you could do that. The other thing is, if you're really going to go into SPX, you know, talk to your accountant, but you could probably use /ES, which is the E-mini S&Ps, and I think that you can probably get a tax break on that, because I think the tax brackets are different for that. But please talk to your accountant about that. The other thing is, if you're using SPY for the smaller accounts, maybe less than 100,000 or so, I'm just ballparking something, you could use SPY. But if you find yourself trying to hedge it with SPY up to 10 contracts, that's really when you need to start looking at SPX, like you mentioned, or /ES, which I'm pretty sure you get more favorable tax on that. So you might aim at a 33 delta continuously, take profits regularly, roll whenever required. Is that a quick summary? Absolutely. That's exactly right. You know, and the beauty in doing that 33 delta is it also allows you, if it's against you, to manage that risk on a spread, so you can keep that dream alive and collect more credit and lower your break even on it in a sense. So and I do that a lot with strategies that go against me. I continually start to roll those out, and you know, you can watch it on the daily market commentaries. I talk about it. I mean, it's been a month or so now since I covered my Twitter, but I had Twitter on the year. I was short some puts in Twitter, and literally, you know, Twitter went from 25 or something like that. I think it was short to 20 puts, and continually rolled those puts over and over and over and over and over, and made my break even. You know, lowered my break even from like what was $19 and maybe 50 cents in the beginning to below $18. So I got out when it was a scratch, but you know, as soon as it got up to $18, you know, sure, it did go a little bit higher thereafter, but it was a way to manage that. So kept it alive, kept collecting credits, because you know, when you're rolling that out, you're really collecting extrinsic value that's going to decay, and you'll be able to take advantage of that. On synthetic longs, Lawrence, sorry, is asking about what about earnings. Yeah, I would wait for after the dividends to do synthetic longs. Try and wait for after that ex-dividend date. Just because, you know, they're going to take that dividend out of the price of the underlying, which is also going to take out that dividend from the price of your strikes, and or it's going to lower it. Do you hold through earnings? If you have a profit, you know, actually in these Trader Hacks videos, I actually even talk about how you can figure out what the earnings are, so you could look at it like, you know, you can figure out what the expected earnings is, and then take that into account whether or not it's worth it. Like if the dividend is only going to be 10 cents, then I'd probably hold it through the earnings. You know, just as a ballpark, depending on what the size the underlying is. You know, if it's a $5 underlying, then 10 cents is going to be quite a big percentage of it. But if you don't know what the dividends, you can check it out with this Floor Trader Hacks video. I show you how to figure out what the dividend is expected to be. And usually it's pretty close. You know, it's a pretty good ballpark. And that's before they even release it, so you can check that out. On the Twitter trade, when you rolled the puts, did you ever go in the money? Yeah, my puts were in the money. I was short the 20 puts, which were in the money. That's why I ended up rolling those out consistently. And yeah, I was getting, you know, I was taking some heat on those for a while. So, I mean, but I have a higher risk parameter, and I was pretty bullish on Twitter. I mean, Twitter's doing a lot of good things, and I was kind of waiting for them to get like a new CEO or something like that, get some big news, maybe a nice buy, buying somebody out or something along those lines. So, you know, I was still pretty bullish on them. Is there not the risk of getting a sign? Well, great, yes, there is the risk of getting a sign, but like I said, I'm not going into that last 7 days, so I'm usually when those are, I'm trying to roll out those ones that are in the money. I'm looking at rolling those out 15 days before expiration, because usually, you know, I do have the risk of somebody doing early assignment, of course, but that doesn't happen a whole lot. And I talk about all that stuff, like the thought process behind the rolling in my daily market commentaries. So you can check that out. Stick with me on them, and you know, they're like mini webinars. I talk about how to defend everything. So, all right, guys. If I don't have any more questions, I'll let you guys go for the weekend. All right. Thanks for joining us. If you can't take that, take it easy.